I used to think dividends were the safe path. Not exciting, not flashy, just steady, predictable, adult investing. I liked the idea of being paid to wait. I liked seeing cash hit the account even when markets were ugly. It felt responsible. It felt calm. It felt like something that couldn't really go wrong if I just stayed patient. And for a long time, I didn't question it. I didn't question the assumptions. I didn't question the math. I just assumed that safe meant smart. It took me years to realize that dividends didn't fail me. My understanding of them did. I'm not telling this story as someone who hates dividends now. I still use them. I still respect them. But I no longer treat them as the foundation of a portfolio just because they feel comfortable. This is what I wish someone had explained to me earlier. Without hype, without ideology, without trying to sell me anything. When I started, dividends solved a psychological problem for me. I didn't trust myself with volatility. I didn't trust growth stocks because price drops felt personal. When something went down 20 or 30%, I didn't see temporary drawdown. I saw failure. Dividends felt different. Even if the price dropped, the payment still came. That felt like proof that the investment was working. It gave me something tangible to hold on to when prices were moving against me. So I leaned into it. Hard. I built portfolios around yield. I optimized for income early. I told myself that cash flow was what mattered, that appreciation was secondary, that income meant control. What I didn't understand yet was that I was optimizing for feeling, not for outcome. At first, everything looked fine. Dividends arrived, the spreadsheets looked clean, the strategy felt mature. But when I zoomed out, really zoomed out, something didn't add up. The first crack appeared when I tried to answer a simple question honestly. How long will this actually take to matter? Not feel good, not look productive, but materially change my financial position. I realized that early dividends are mostly symbolic. They feel like income, but mathematically they're almost irrelevant at small portfolio sizes. That doesn't mean they're useless. It means they're misunderstood. If you have $10,000 invested and you're earning 3 or 4%, you're getting a few $100s a year. That money feels real, but it's not doing anything meaningful yet. It's not replacing income. It's not changing risk. It's not buying freedom. And that's fine, as long as you know that's the phase you're in. The problem is that I treated that phase as the destination. I optimized for yield instead of scale. I chased the feeling of being paid instead of building the engine that would actually generate long-term results. At some point, I did what I should have done from the start. I stopped asking how safe dividends felt and started asking what they actually did to the numbers over time. And that's when the illusion broke. Dividends aren't free money. That part is true. They come from earnings that could have been reinvested. The payment itself doesn't magically create value. What dividends really do is change who controls the cash, you or the company. That's not inherently good or bad, it's just a trade-off. The issue is that I assumed dividends automatically meant better discipline and lower risk. In reality, dividends just move risk around. Sometimes they reduce volatility. Sometimes they increase opportunity cost. What really matters is how the business grows its earnings and how efficiently capital is allocated over time. I had to confront something uncomfortable. Many of the high-yield positions I felt safest owning were the ones growing the slowest. They weren't broken businesses. They just weren't compounding engines. They paid me today at the cost of tomorrow. And when I ran long-term projections, not optimistic ones, just realistic ones, the difference was brutal. Portfolios optimized for income early often lag in total return for a very long time, sometimes decades. That doesn't show up in year 1, or year 3, or even year 5. It shows up quietly, in the background, while everything feels stable. This is where most people get defensive, because dividends feel like discipline. They feel like responsibility. They feel like doing the right thing. And I get it. I was there. But safety is not the same as progress. A strategy that feels calm but compounds slowly can quietly cost you years. Another thing I misunderstood was the famous dividend snowball. I heard people talk about it as if it just turns on at some point. Like one day you wake up and suddenly dividends are doing all the work. That part is real, but the conditions are rarely explained honestly. The snowball doesn't start because dividends are magical. It starts because the portfolio reaches scale. Scale is the actual milestone, not yield. At small sizes, dividends are background noise. At large sizes, they become force multipliers. But here's the catch. If you slow down growth too much in the early years by prioritizing income, you delay reaching that scale. I didn't realize that by trying to feel paid early, I was pushing the real payoff further away. Another mistake I made was treating dividends as income instead of as reinvestment fuel. In my head, dividends were money earned. In reality, until a portfolio is large enough, dividends should be thought of as additional shares. When you mentally label them as income, you judge them by income standards. You compare them to effort. You ask why they're so small. When you label them as shares, you understand that they're not supposed to impress you yet. They're supposed to quietly increase ownership. That mindset shift alone would have saved me years of frustration. There's also the tax side, which I ignored for far too long. Dividends feel clean, but taxes are friction. In taxable accounts, that friction compounds in the wrong direction. Paying taxes early on small amounts might feel harmless, but over decades, it adds up. Especially when those dividends could have been deferred, reinvested, or allowed to grow untaxed in other structures. I wasn't wrong to like dividends. I was wrong to ignore where I was holding them and why. Another hard truth: dividends don't protect you from bad businesses. I subconsciously associated payouts with quality, but companies can pay dividends and still destroy capital through poor growth, bad buybacks, or structural decline. Yield is not safety. Stability is not immunity. Some of the biggest drawdowns I've experienced were in safe dividend names that never recovered meaningfully in real terms. They didn't collapse overnight. They just went nowhere for years while paying me small checks that made it feel okay. That's not safety. That's stagnation with a mask on. At some point, I stopped asking, "Does this pay me?" and started asking, "Does this grow per share value over time?" That question changed everything. It forced me to look at earnings growth, payout ratios, balance sheets, reinvestment returns, and capital allocation discipline. It forced me to accept volatility in exchange for progress. And that was uncomfortable. Because growth strategies test patience differently. They don't reward you with constant feedback. They reward you later. Dividends whisper. Growth is silent. Most people quit in the silence. That's why dividends feel safe. They talk back. But talking back doesn't mean they're leading you where you think you're going. The biggest realization for me was this: investing is not about choosing the right asset class. It's about choosing the strategy you can execute correctly for decades. Dividends didn't fail me. My expectations did. I expected them to do the job of growth. They're not designed for that. They're designed to distribute. Once I reframed dividends as one tool instead of the strategy, everything became clearer. I stopped forcing income early. I stopped chasing yield. I stopped treating calmness as success. Instead, I built around growth first, with dividends as a stabilizer, not the engine. That doesn't mean all growth stocks. It means growth of earnings, growth of cash flow, growth of intrinsic value. Some of those companies pay dividends, some don't. What matters is the direction of the business, not the payment schedule. Another lesson I learned the hard way. Behavior matters more than math. I know people who could have made more money with growth but couldn't tolerate the swings. They panic sold, jumped strategies, or quit altogether. For them, dividends weren't inferior. They were survivable. And survival beats optimization if optimization causes failure. So the real question isn't, are dividends good or bad? The real question is, what problem are you trying to solve? If you're trying to stay invested through volatility, dividends can help. If you're trying to build long-term wealth efficiently, dividends alone are not enough. If you're trying to replace income early with a small portfolio, dividends will disappoint you. If you're trying to build a machine that works without constant decision-making, dividends can be useful at the right stage. What I would tell my younger self is simple. Stop asking how safe something feels. Start asking what it compounds into. Run the numbers forward. Include taxes. Include opportunity cost. Include behavior. And be honest about timelines. Dividends are not a shortcut. They are a tool that works best after the foundation is built. I wish I had spent fewer years trying to feel secure and more years building capacity. Because real safety doesn't come from payouts. It comes from margin. Margin in your budget. Margin in your strategy. Margin in your time horizon. If you're early, focus on scale. If you're mid-stage, balance growth and income. If you're late stage, income finally makes sense. But don't confuse stages. That's the mistake. Dividends didn't betray me. They just never promised what I assumed they would deliver. And once I accepted that, investing stopped feeling comforting and started becoming effective. That's the trade most people avoid. Comfort now or freedom later. I chose comfort for too long. You don't have to.